Good afternoon to you in Somaliland. It's still morning here in the UK, but I know it's after prayers with you. And welcome to the first of the webinars, which is going to deal with the contents of PFM for Somaliland. What I'm going to do today is to deal with, just let it load up, with workbook number 1, which deals particularly with budget preparation. I know you've already covered this in your courses, and I'm not going to repeat everything that's in your courses. It's quite a long workbook, but I want to go through and deal with just some of the main points that I want to emphasize and which are important to you in the context of your work in Somaliland. So I'm going to look at 7 areas in total: the PEFA framework, budgeting and the MTEF approach, the macro and fiscal framework, medium-term budget framework, budget documents, output and performance budgeting, and investment planning and capital budgets. First of all, the PEFA framework. Now this is in the first part of your workbook, and it's particularly important. PEFA stands for Public Expenditure and Financial Accountability. It has its own website, which is up on the screen, www.pefa.org. It's the most authoritative basis for assessing the quality of PFM within a country. And it's supported by a number of major international organisations: the IMF, the World Bank, the European Commission, and then countries: France, Norway, Switzerland, and the United Kingdom. And it forms the basis for an objective assessment of PFM, the quality of public financial management within a country. And if you look at the PEFA website, you will find that there are a number of PEFA country assessments online. Just let's have a look at the PEFA framework first of all. The PEFA framework can be linked and is linked on their website to the PFM cycle we discussed in the introductory course and is again in the introduction to this workbook. The numbering doesn't follow the sequence there, so I'll follow this round. Starting at the top of the circle, we have policy-based fiscal strategy and planning. Basically, that's the stages before you get to your budget preparation that we'll talk about this afternoon. And then budget reliability, which obviously follows on from that. Number 5 is budget execution. It actually reads predictability and control in budget execution. It's the same as the cycle we've talked about. 6 is accounting and reporting, the same. 7 is external scrutiny and audit, the same. Then 2 extra dimensions that we've got here: transparency of public finances, which is really linked to reporting, and the management of assets and liabilities, which is a general requirement of any public financial management system. So there are 7 pillars to the PEFA framework, which, as I say, link to the PFM cycle, although they vary it in some ways. And within those 7 dimensions, there are 31 indicators. Now I'll explain what I mean by indicators a little bit more. And some of those indicators have more than one dimension, which is really, by dimension, it really means a sub-indicator. So there are 7 dimensions, 31 indicators, but with a number of sub-indicators. And the concept is that they provide objective criteria for measuring the quality of PFM within a country. And that's best explained by looking at one of the indicators. If we look at PFM indicator number 1, the abbreviation is PI, Performance Indicator number 1, which is titled Aggregate Expenditure Outturn. Now, every one of the indicators is in the format that you see on screen here for indicator number 1. There is a score. So when you assess a particular country against this indicator, you'll get a score between A and D. It's just like an examination with 4 grades, A, B, C, and D. A is the best, D is the worst. And then there are the criteria to get a particular grade. So to get an A, you've got to meet the criteria in black. Aggregate expenditure outturn was between 95 and 105% of the approved aggregated budgeted expenditure in at least 2 of the last 3 years. In other words, your budget, and when we say the budget, we're talking about the budget that is approved by Parliament, is within plus or minus 5% of the actual expenditure for that year as recorded in your audited accounts. And to get an A grade, you must have achieved that for 2 years out of the last 3. You could miss it in 1 year. So this does allow 1 year where something happens and you're not within it. But within at least 2 of the last 3 years, and it can't be any 3 years, it must be the last 3 years, your budget is within 5% of your actual outcome. That gives you an A score. Then B and C scores are your budget is progressively less reliable as a predictor of what's going to actually happen. B is within 10%, C is within 15%. And if you're more than 15% off, then you get a D. Doesn't matter how much you're off. If it's more than 15% in those years, then you get a D score. Now, the point to notice is that every one of the indicators has a score between A and D. They're quite consistent on this. And every one will have a number of criteria against which you measure the score. And as far as possible, they are objective criteria. So if you look at this example, there's not much scope for discretion. There's no scope for discretion. I mean, you get your budget documents, you get your accounts, you compare the two, you work out the percentage, and that gives you your score. There's no element of judgment involved. As far as possible, most of the indicators are designed so that they are objective. So that if you go through and you follow the rules carefully, and it's quite a major exercise carrying out a PEFA assessment, gathering a lot of information. But if you go through and follow it carefully, you will get an evaluation of the PFM system within your country, and you will identify where it works well, where you've got good scores, A's and B's, and where it doesn't work so well. It provides a benchmark of public financial management in a particular country, or it can be applied at a subnational level where you've got a federal structure, particularly not really designed for local governments, but where you've got a federal structure and states within a country, such as the USA. It could be operated, you could do an assessment at the state level. And as I said, those assessments, when they've been through and they're approved by the national government, and only then they will be put online on the PEFA website so that you can look at them and you can see how different countries are doing and you can compare your own country to them. Although I said it's like an exam, the objective is not to pass. The objective is to use it as the basis for the design of a PFM reform program. So you benchmark where you are, you identify your areas of weakness or where you need improvement, and then you have the basis of a reform program. And it's fundamental to the PEFA approach that should be country-led. However, in practice, much of the PEFA assessment and reform design is in fact driven by donors. So although it should be country-led, it does not always happen. So the PEFA assessment is very important in 2 ways. First of all, it can be used by a country to design a reform program. And secondly, it gives us a basis for international comparison between countries. And also, and in addition to that, it provides you with an indication of what is best practice in each area. And you'll find as you go through the workbooks of this course, we will be consistently setting out what the PEFA indicators in a particular area are, so that you can evaluate your systems against them and see where there's room for improvement. So it really is very important. And I would encourage all of you to look at that PEFA website. Okay, let's go on to talk about budgeting and MTEF, medium-term expenditure frameworks. First of all, I want to talk about some basic concepts that we use in the whole of budgeting and planning. Some terms that are used, an explanation, and then the equivalent to that term in the context of Somaliland. First of all, there's policy, a political or social vision or aspiration, which for Somaliland is Vision 2030. Secondly, the plan, how to implement the vision for Somaliland, the National Development Plan, NDP. Thirdly, we have the strategy. What do you do to get there, to get to the plan and the vision? In Somaliland, it's the medium-term budget framework. Distinct from those is forecast, which is an estimator of items in a plan that cannot be fully controlled. And an example is the revenue forecast incorporated in the macro and fiscal framework. You cannot completely control the amount of revenue collected because there are factors outside your control. And then finally there's the budget, which is also the budget, which becomes law in the Appropriation Act, which forecasts revenues and combines those with your allocation of those expenditures as enacted in the budget. Now, most people find that quite confusing, so I've done a diagram which I hope makes it clear. On the left you have a pyramid. At the top you have your vision. Underneath that the plan, how you put your vision into practice, and then your strategy, your actual actions that you plan to undertake to put your plan into action. And on the right you've got an arrow which is your forecast of the future revenues, for example. And in a budget, what you're doing is you're combining those together. You're combining your strategies and your forecasts of revenues to produce a budget. So your budget contains elements which you can control, your expenditure, and elements which you can only control to a limited extent, such as your future revenue. That's important because that gives us an understanding of the budget process and what you're putting together in the budget. How does that work in Somaliland? I'm trying to use Somaliland as far as possible as an example of this because the new procedures set out in the 2016 Public Financial Management Act do conform quite closely to international best practice. And so you need to look at these and need to see how these will be implemented. So you have at the top the government goals and plans, as we said, Vision 2013 and National Development Plan. Those have got two sub-elements: fiscal strategy, which is the macro and fiscal framework, sector strategies. Sector strategies, there's no specific sector strategy concept mentioned in the Act of 2016, but you do have the National Plan which contains sector strategies, and there's also a requirement for ministry policy statements which are effectively sector strategies. So although not mentioned by name, they are in fact there. Those are combined together in the medium-term budget framework, from which you move to the annual budget preparation process. You have the budget circular, guidelines, and then the budget submissions by MDAs. MDA stands for Ministry, Department, Agency, who make their budget submissions, which are combined into the annual budget. I say that conforms quite closely to international best practice. But this is, of course, the proposed system under the PFM Act of 2016. It's only now starting to be implemented. Looking at elements within that, let's look at the macro and fiscal framework. The requirements of the Act is that you should have a macro and fiscal framework which would show the total public sector resources. That's actually a very big part of it. I'll talk about that in a moment. The sub-allocation of that to individual programs. It should also set out the fiscal management. I'm not sure what it means, whether it should set out the processes or the policies of fiscal management, but I'll assume it means the policies, and how you'll coordinate international intergovernmental relationships. Number 4 is basically about grants. Grants you receive and grants you make to, for example, local level governments. Now, all of those should be contained in your macro and fiscal framework. In terms of international best practice, it's essentially the same as a macro and fiscal framework, MFF. And I would expect it to have substantially the same contents as you would expect in a macro and fiscal framework. A historic review of economic growth and performance, a review of past and expected inflation, government financial results compared with budgets over a number of years, however many you've got available. In Somaliland, as a new country, you're quite limited in how far back you can go, but you normally expect to have 5 years of financial results compared to budgets. A summary of the challenges that you have in implementing the current budget. What are your major problems, besides the fact you probably don't have enough money, but there will be other issues as well. Your fiscal priorities. What's your major objective in terms of fiscal policy? Is it to reduce your level of borrowing? To increase the amount you collect in taxes? Some combination of items such as this. And fiscal projections, forecasts. Fiscal projections, that means the forecasts of your expected levels of revenues and expenditures and borrowings over the next 3 to 5 years. Any changes in your priorities for future budgets, maybe a change in priority perhaps from, say, security moving towards education, a change in priorities in the future that you expect to have. And then really important, the last one, sector and ministry expenditure ceilings. Again, looking at that as a list is, I think, quite difficult. I find it easier to look at this as a diagram of what you're actually trying to do, and this would apply to your medium-term fiscal framework or your Somaliland, let me just get the word right, your Somaliland medium macro and fiscal framework. The first thing you're trying to get to is in the blue circle in the middle, national resource ceiling, often referred to as the resource envelope, because it's like a wrapper of how much resources, how much money you'll have available. And you get to that by combining a number of different things. First of all, your net borrowings, plus or minus, so that would be the amount of you borrow less the amount that you lend out or repay. In Somaliland, I would expect you to be increasing your net borrowings year on year. Your revenue forecasts, we'll talk a bit more about those in a moment, but your forecasts of your revenues, plus or minus your net transfers, grants, grants received and grants paid, as we just mentioned. Again, in Somaliland, I expect that to be a plus. We'd expect you to receive more in grants than you pay out. And then at the bottom, any other known factors which will impact on your flows. For example, if you're in the middle of a drought, as you are in Somaliland, how that will impact on the resources that are available. Put all of those together, and you've got the national resource ceiling or envelope, as we said. You then allocate that to your sectors, your economic sectors, and ultimately to your ministries. So that each ministry will have its own resource ceiling within which it's got to operate. And then at the ministry level, we go through the process of taking that resource ceiling and taking out your known future commitments, for example, for capital expenditure and for overhead costs that you cannot get rid of. And what you're left with is the ministry fiscal space. The amount of money that the ministry has got that it can use to undertake different programs. I'll come back to that in a moment. Let's talk first of all about forecasting revenues. There are various statistical tools you can use in historic data. You're not expected to understand these for the purpose of this course. Those of you in the budget department will actually receive some special training in the use of statistical tools. Probably for Somaliland, the bottom one, the moving average, is the most appropriate. It's the simplest and is most appropriate way for a limited range of historic data. Using these tools can provide you with a very good indication of the trend of your revenues and help you to forecast the future. Although you've got to remember that those trend lines can be changed by external factors. For example, if the oil price collapses, then the ability of some of your major customers for exports to buy your products, camels, if oil price collapses, will decrease, and therefore your revenues will decrease. So although you can use trends from history, you must take account of changing situations in the future. That's how you forecast revenue. The other thing I just want to talk about is this concept of fiscal space. If we take the Ministry of Health as an example in a fictitious country, the total resources allocated to it, let me just go back a moment. The total resources allocated to it in that grey box on the right, they're allocated to sector ministries. So we look at the amount that's been allocated to the Ministry of Health for 2018, 2019 and 2020. It's $15 million, $16 million, $18 million. Or as total national resources allocated to health, is 2.25 million, 2.4 million and 2.7 million. And the Ministry of Health has got forward commitments, for example, a hospital building program of $600 million, $600,000 in 2018, $750,000 in 2019. Nothing planned for 2020 as yet. And it's also got overhead costs, which it cannot reduce. So these are going up a little bit each year: $500,000, $525,000, $551,000. Take those in total away from the amount allocated to health, and you're left with what is referred to as your fiscal space: $1,150,000 in 2018, $1,125,000 in 2019, and then a big jump, $2,149,000 in 2020. That's the amount of money that the Ministry of Health has got to spend on a discretionary basis. For example, on an immunization program, on a child health education program. That is up to the Ministry of Health, how much it spends on its different priorities. But the point is that although it's got a total budget in 2018 of $2,250,000, 1.1 million of that is already committed. So it's actually only got 1.15 million to spend at its discretion. So this concept of fiscal space is very important, and it's why when we talk about commitments, it is important to know your forward commitments, because without that information, it is not possible to see how much money you can make decisions about spending. Medium-term budget framework. The principle of the medium-term budget framework is it combines your resource forecasts. Don't forget, that's not just your revenue, that's all your resources, your grants received, your borrowings. It combines your resource forecast with your sector strategies. The ministry strategies in the case of Somaliland. Put those together and you have your medium-term budget framework. In essence, that's what it's about. Concept of a medium-term budget framework is that it is a rolling plan. So in 2018, you'll have it in 2017, for 2018, you'll have a 3-year plan of which the 2018 budget is the first year. It doesn't have to be 3 years, it could be 3 years, it could be 4 years, it could be 5 years. 3 years is quite normal. So the first year of your medium-term budget framework is in fact the 2018 budget, which will be enacted at a line item level of detail. For the years 2019 and 2020, you will have a forward budget, a medium-term budget. It will probably be in less detail. It will probably be only down to a high-level allocation. Again, there are no rules about this, but normally you would have quite a high-level forward budget in your medium-term budget framework. For 2019, when you come to do your MTBF next year in 2018, you will roll forward 1 year. Obviously, you will drop 2018 because that's the current year, but you will add 2021. And your first year is now the 2019 budget. And that should be based on the 2019 budget which you had in 2018. So you shouldn't start again. The idea is that you take your budget from your 2018 medium-term budget framework and you provide more detail and make a few adjustments, but basically your 2019 budget should be based on that original budget. And going forward to 2020 becomes the budget year, but you would already back this year have had a good indication of what that budget will be. So the concept of an MTBF is not just that it combines, as we've said, fiscal forecasts and fiscal plans with sector strategies, but it also does so on a rolling 3-year basis. Now, there is general agreement that moving to this type of approach is an improvement on just an annual budget. It gives you a much longer perspective of what's going to happen in the future, and it gives you a framework within which you can combine fiscal factors, how much money you've got, with what you're trying to achieve through your sector strategies. And this is what is trying to be achieved through your new PFMA 2016, the new Public Financial Management Act 2016, is to move to this type of approach. Going to be a major challenge for Somaliland, of course, but it will definitely be a move forward. The annual budget. I'm not going to talk for very long about the annual budget. Most of it, in fact quite a lot of it, you actually covered in the introductory course. There's a lot of detail in the workbook which you do need to be familiar with, but it's really fairly straightforward. Just a few points really on some of the PEFA requirements. Remember I said we'd come back to these PEFA indicators and use them as an indicator of best practice. And two are particularly noteworthy. PEFA indicator number 17 is a requirement for orderliness in the budget process. So this is actually one of the standards by which you are judged. And under orderliness, there are actually 3 dimensions, 3 sub-indicators: the budget calendar, the budget circular guidelines, and the budget submission to Parliament. And the requirements for best practice under each of these, under the budget calendar, it should, well, first of all, it should be there one, it should exist, and it should be followed. No point in having a budget calendar if you don't follow it. And it should provide that the budget units, ministries, have at least 6 weeks to prepare their budget submissions. So the ministry should receive the budget guidelines at least 6 weeks before they're required to make their budget submissions. Second criteria is that there should be budget circular guidelines which would be issued to all budget units, again, ministries. They should cover all government expenditure. So it's no good having budget guidelines which only cover part of your government expenditure. They should comprehensively cover all government expenditure in total, and each ministry should be provided with a budget ceiling, its own resource envelope. And we've already said that earlier on and shown how that's arrived at. So each ministry should have its own budget ceiling. And the third requirement is that after all of the ministry budget estimates have been consolidated by the Ministry of Finance, the budget should be submitted to Parliament at least 2 months before the start of the fiscal year. So in Somaliland, the budget should go to Parliament no later than the 31st of this month, 31st of October for 2018, to give Parliament adequate time to review the legislation. So 3 requirements, but they are a specific PEFA indicator. And a further PEFA indicator is to do with the budget documents. So it doesn't just say the timetable, it also says what the budget should contain after it's been approved and published. On this slide that's appeared on the screen, little dotted boxes, ignore those are just a technical glitch. In the indicator, it identifies the budget documents, 12 in total, and it divides them into basic elements, which are essential, and additional elements, which are desirable. So the budget documents must contain a forecast of the fiscal deficit or surplus for the budget year, 2018 if you're preparing it in 2017. It should show the previous year's budget outturn. That means the 2016. So you should have the 2016, what actually happened, included in the budget, and the current year, that's 2017, either a revised budget or the estimated outturn. Basically the latest budget, but preferably an actual estimate of where you'll be at the end of the year. If you've got good accounting systems, you should be able to make a good estimate of the budget outturn by the time it goes to Parliament this month. You should have a pretty good idea where you'll be at the end of the year. And it should include within it, under those headings, the aggregated budget data, revenue and expenditure data, divided under the main heads of the classification for both the current year, that's 2017, and the previous year, 2016, with a detailed breakdown of revenue and expenditure forecasts. Now those are all essential, and to get an A score you must have the first 4. Then there are the additional requirements, and for an A score you should have at least 6 of numbers 5 to 12. It means basically you've got to have all of them except 2. It could be any 6, but you must have at least 6 of them. Obviously, ideally, you should have all of them. Very briefly, they include deficit finance, how you're going to finance yourself, your macroeconomic assumptions, 7 and 8, debt, stock and financial assets, basically loans, loans made, loans received. Fiscal risks, talk about those in a minute. Budget implications of various things, so a narrative description in number 10. Number 11, documentation on medium-term fiscal forecasts, how you made them, what are the assumptions. And number 12 is quantification of tax expenditures, money spent directly from tax, which I'm not going to talk about in detail as part of this course. Very demanding list, that is, of documents that should be there for a good budget system. Documents that should be laid before Parliament and then published by the government. You can go away and compare how well you do in Somaliland against that list. Fiscal risk we mentioned. Fiscal risk is an important concept. In the PEFA assessment, they identify 3 dimensions, sub-indicators, of fiscal risk. Public corporations, basically, if you own companies, state-owned enterprises, they represent a fixed risk in terms that they may not do as well as expected. They may even become insolvent. And the requirement in the PEFA assessment is that you should have up-to-date audited financial statements from each of those public corporations, state-owned enterprises, and obviously they should ideally comply with IFRS, International Financial Reporting Standards. Exactly the same for some national governments, so I won't repeat myself. And then the third element, and perhaps the most important element in many ways of fiscal risk, is contingent liabilities. I haven't done a slide on this, so I'll have to explain it verbally. By contingent liability, let me give you an example. If the University of Hargeisa borrows commercially $1 million, and that loan to the University of Hargeisa is guaranteed by the government of Somaliland, it's a liability for the University of Hargeisa. It's a contingent liability for the government of Somaliland. It's contingent because as long as the University of Hargeisa could meet its payments in terms of the loan, then it's of no concern to the government. They don't have to make any payments. But if the University of Hargeisa was unable to meet its obligations and could not make the due repayments, then because the government of Somaliland had made a guarantee, the liability, it becomes a liability of the government. It's made a guarantee, it's got to make the payment. It's contingent as long as the University of Hargeisa is making the payments. If and when the University of Hargeisa fails to make those payments, it becomes an actual liability. And there should be, for the government of Somaliland, a fiscal risk paper consolidating all of those fiscal risks, particularly contingent liabilities, all of the guarantees. And there's not just explicit guarantees, there's also what are called implicit guarantees. In many cases, the government may not have guaranteed a loan, but in practice it will have to make payments if the entity to which the loan was made did not meet those obligations. That happened in the UK, for example, in the 2008 banking crisis, when the loan obligations of some major commercial banks were taken over by government, which had never guaranteed them, but the impact of the failure of those banks was so great that the government had no choice but to take over the loans. So a contingent liability may be explicit or it may be implicit. Now that's a big subject area in itself, and we won't go into this any further in this course. But be aware of the concept of fiscal risk. It's an important area. That's basic budgeting, and really that's as far as we need to go in relation to Somaliland. But two further areas that are important and are included in your workbook. First one is output and performance budgets. There's a fundamental problem with the public sector accounting, and it's early on in your workbook, but I'm including this diagram now because it's really relevant in this context. The problem with public sector accounting is you know how much you spend on goods, on services and people. Just like a commercial company, you know your expenditure. The government then does things with those which we hope adds value. So if I take health, for example, you will spend money on hospitals, on equipment and medicines and drugs, and on doctors and nurses to deliver health care for the citizens of Somaliland. But you don't, at least I assume you don't, sell that health care. You don't expect people to pay a commercial amount for it. They may pay some hospital fees, but it's not the actual cost of the services they require. which is different to a company which is selling widgets, where you will expect people to pay enough money so that you make a profit. But in government, you don't sell your outputs, you deliver services, healthcare, education, security. They are services that are provided, not sold. And so there is no profit. Now that's very good. That's the nature of the public sector. But it does mean that you cannot use profit to measure how well you're doing. There is no profit measure of performance. So your problem is the phrase in text at the bottom of that diagram: how do you relate financial inputs to non-financial outputs of service delivery? And that's why in the public sector, really only in the public sector, we have the concept of outputs and outcomes. Let's have a look at those in terms of this diagram. Really repeats just what was on the previous one, but with some more boxes added. You have your inputs, you know, if you're going to have a vaccination program, how much you're spending on vaccination. You then carry out the activity, you vaccinate people, you give vaccinations. Your output is the number of people who you vaccinated. That's pretty easy to measure, and you can count them. The outcome is increased life expectancy. Now you can measure over a long period of time changes in life expectancy, but how much of that is a result of your vaccination program? How much is a result of other factors, healthcare, lifestyle, genetics? So when we're trying to measure performance, we can compare inputs to outputs. We've already got a problem because one's in dollars or whatever your currency is, and the other one is in number of units of vaccinations, but it'll be different. You know, a different area will have a different output. Even more difficult is to measure your outcome. Now, there's no easy solution to this. This is a basic problem of public sector financial management. Measuring outputs can be useful, and it is useful to have some measure of outputs. And I'll use the example that's in your manual, in your workbook, of repairing a canal. You've got a budget to repair 40 kilometers of a canal. I don't think you have many canals in Somaliland. It could be a road, whatever. You actually repair 45 kilometers, which is great. You've done 13% more than you budgeted for. You've then got your costs in terms of staff, casual staff, materials, transport costs, which gives you a total budgeted cost of $21,200. But you actually spend $21,850, so you're 3% over budget. But then on the other hand, you did 13% more kilometers than you expected. Putting those together, your cost per kilometer is better than budget. You budgeted to spend $530 per kilometer. You actually spent $486 per kilometer. So your actual cost per kilometer is 92% of your budgeted cost, which is good. That's your expenditure. What did you achieve? What's your output? Well, the simple measure is the boats per day using the canal. Before you started the repair work, only 26 boats a day used the canal. 3 months after the repairs were completed, you expected to have 104 boats a day. You actually got 120 boats a day, so you did 15% better than your budget. And then you can look at outcomes, and you can say, well, an outcome here is how many farms can achieve the same day delivery to market. Very important if it's perishable goods. Milk, for example. How many farms could achieve this? You budgeted for 25, you actually only achieved 21. So although more boats were using the canal, for some reason, the number of farms achieving same-day delivery is not as good as budgeted. And you can also look at the value of goods traded in the market, but we actually don't have any information on this, so we don't have that measure. Now, you've got quite a lot of information there. In the workbook, we suggest ways that you can analyze this information and reach some conclusions on it and use it to make some policy changes. I think there are several points worth making about this example. The first thing is that you could have an overspend but it can actually be a good thing, because if your outputs increase by more than your overspend, your cost per unit goes down, as has happened here. You wouldn't get that if you just looked at your expenditure, but by looking at your kilometers of canal repaired, your first output, you could actually see that you did better than you expected to, even though you've got a small overspend. Secondly, you've got a good indication of the usage of the canal and how that's been impacted by these repairs. Better than expected. But you've got a problem with same-day deliveries, which is actually not done as well as you expected, and you need to investigate that further. Find out the reasons. Maybe the canals have been repaired, but the onshore facilities to handle the goods are not as good as they should be and couldn't cope with the extra number of boats using the canal, for example. We don't know. That needs to be found out. The point is with this is that it's starting to build a more comprehensive picture of what you're doing with your expenditure than only looking at the expenditure. Even though it's difficult and you can't measure outcomes easily, it's better. And that leads us to a way of looking at expenditure. The traditional way is to organize expenditure under what's called line items. So you organize them under, I've taken a particular water sector here, where you've got water management, the environment, waste and recycling, for example. So you subdivide your ministry into these different departments. And then you normally look at what you spend under, say, administration, how much you spend on salaries, how much you spend on supplies and so on. But under a program approach, you say, well, how much did you spend on different things, for example, a new IT system, or under water management, a new water supply and new sewage treatment improvements? It begins to give you a better picture of what's going on. The problem with that approach is that you actually will have managers within a department who are responsible for different areas, and these may cut across some of your programs. And so what's often advocated is a matrix structure. Now, this may be difficult to read. It's taken directly from your manual, but there was too much detail to show in a large print size. A matrix structure, basically you have a two-dimensional structure. Across the columns you have your organizational structure, and your rows represent your different areas and the programs within those areas. And this is a way that is sometimes advocated to have both an organizational structure which shows managerial responsibility and a program structure which shows what you're trying to achieve and can be related to outputs. Again, this is a big area. We're just beginning to talk about it. That's all you need to understand at this stage. And I'll just mention finally that you can use this approach, you can link it to your medium-term budget framework through this approach. Basically, your macro fiscal framework gives you your financial budget and your medium-term budget framework. If you have sector programs of the type that we just talked about, you can have performance goals for each sector program. You can use those, you can combine those with your financial budget to get a budget and performance management framework. That requires some sort of sector strategies in the bottom row and some sort of performance monitoring framework. Now, Somaliland is not there yet. It's not appropriate at this stage, but it is where you should be going in the future. But it is difficult. As we said, there's a problem of linking programs with organizational responsibility. There's a problem of setting performance goals. That's why it's not as yet appropriate, but it will be in the future. Finally, I'm going to talk about investment planning and capital budgets very briefly. Again, these are not part of the current 2016 Act. But obviously there's something you are talking about. We're talking, when we say capital investments, we're talking about creating financial assets, fixed assets rather, creating fixed assets. infrastructure assets such as roads and airports, buildings, hospitals and schools. And the characteristic of all of these is that they tend to be expensive and they tend to have a long life, which makes them quite different to a lot of routine expenditure on staff costs and consumables. And because they extend over a long period of time, they will represent a future commitment. So when we're talking about fiscal space, one of the things that reduces your fiscal space available will be building programs that you entered into some years ago. For example, we're at the moment in the UK, we're building a major rail network which is going to extend 10, 15 years into the future. So you're actually making a commitment which will be there in the budget 15 years from now. So it does make capital investments very difficult. There is a capital investment life cycle which leads through from inception and evaluation and selection, that's before you start, detailed design, the execution, and then the evaluation afterwards. And there's a whole area of financial management dealing with that, which we're not going to get into. But from a budgeting point of view, the point is that these are large, long-term commitments. They reduce the fiscal space, and therefore they require planning through a public investment program. And you'll need to integrate that with your medium-term and annual budgets. Now, even if you don't have a public investment program as such, you will have large-term commitments, and it is very useful to gather these together so that you have an overall management of such commitments. That brings me to the end of what I want to talk about. I see I've got a few queries here. And good afternoon.